Welcome to Tradespoon. My name is Dr. Pal. I'm CEO and founder of Tradespoon and Yellow Tunnel, and today I'd like to go over Strategy Roundtable, where we talk about current market conditions, any questions you might have about subscription, how to take advantage of the current market volatility, what strategies to implement, stock options, and any other strategies. And my goal is to answer any questions you might have. For those of you who are new, welcome. If this is your live event, do me a favor, just type in first or just say hi. Always want to welcome new subscribers. Don, Bob, Joseph, Ray, Buck. Good morning. Buck, I will answer the question about NA. Thank you. Yeah, if it's your first live event, just type in new. If you do appear, trader, welcome. If there is no first name, do me a favor. At some point, update your profile with the first name. We don't collect first name in some sources. So if you don't have a first name, just update your profile with your first name and re-register for the event or open a support ticket. But I always want to, meanwhile, just say, your name. So otherwise you appear as trader. So this is my brief bio as Executive Vice President and Head of Technology at Options Express from its inception through 2007. Options Express was an online broker-dealer acquired by Charles Schwab in 2011. At some point, the company was worth over $2 billion. I'm very proud of that experience. I was their first employee, shaped my professional career. Started Tradespoon in 2012, started Yellow Tunnel a year ago. Want to say thank you to all the subscribers. Because of you, I'm able to do what I enjoy professionally. I've been trading and managing my money for over 15 years, mentoring and teaching subscribers how to trade stock and options, and finally I have a master's degree in computer science, specializing in technology and statistics. Disclosures: trading stock and options involve risk, not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Right, before we get into a trading system, let's go over the market conditions. If you follow my blog or you've been on any of the live events, anybody, how many people are you? This is the first live event. Okay, would love to understand weekly subscriber. Okay, we'll talk about, so weekly subscriber, we'll talk about some of the examples and we can kind of gauge. So, I haven't changed this screenshot, kind of a classic symmetrical triangle, symmetrical wedge. You have higher lows, lower highs after the elections, clean breakout, and then consolidation phase, right? Market is consolidating. It's tried to break through this line already several times and looks like it's rebounding back. We do have this theme between technology. Technology is underperforming. It did not break out to the new highs, right? It's actually retested 50-day moving average. Today, it's a classic example where growth and technology sector is underperforming. You have names like FedEx, Peloton, Costco, Teladoc, Microsoft, Apples of the world. So work from home stocks that benefited from the spread of the coronavirus in the past, since February. How long is it? February, is it 8 months, 9 months? So in the past 8 months benefited from people working from home and staying from home. They are underperforming in general. They're underperforming the sector. And then the stocks that have been affected the most by the spread of the coronavirus, energy, banks, hotels, hospitality services, they are outperforming, right? So we have a strong momentum in the industrial names, in energy, banks, right? So that's the theme after the election, kind of rotation from growth to value. Some people think that this is just a temporary. I think that this is actually going to stay here throughout this year and next year. And I personally would be a buyer on any pullbacks. I would not chase the market, right? This is still a consolidation phase. We will have days where market can be down from 114 to 110. I mean, 3-4% corrections, so pretty volatile market. We are going into runoff elections in January. I think that's probably one of the biggest risks that at least I see. And in addition, potential more strict shutdowns throughout Europe and the United States, which is also a significant risk to the market. So probably not, not chasing the market, but buying into pullbacks. If market rallies, you raise cash. If market sells off, you deploy cash into equities. So I think that's the theme. I would keep an eye on technology and value stocks. I would still build a balanced portfolio. I don't think this is the end of the technology. I think QQQs will retest 300. I think they will break 300, probably, end of this year, early next year, but there will be a breakout. That's what, how I'm structuring my portfolio, but I think value will outperform technology on the upside and on the downside. What are some of the risks to this view? One is Treasury market, right? There's a clear movement of cash from bond market into equity market. You have this descending channel. Nothing has changed. We have strong rebound in Treasury prices, right? Lower yield. This is a market kind of, had this shallow correction in the past couple of days. I think there's more room to go to the upside, right? So that's like headwind for the equity market. If Treasury prices continue to go higher, break out of this channel to the upside, right? Maybe after the runoff elections, then that would definitely pull the market to the downside. So I would keep an eye on Treasury market, right? I have this top to bottom approach when I view the market, and then I would look at the dollar, right? Currency market. This is where money are floating from, right? Equity to currency, currency to treasuries and cash, right? Those are the four places where people park most of their money. Not people, not retail, but institutional traders. US dollar, again, lower highs, lower lows. It's continued to, if you draw this line, you have a lot of overhead resistance at 95. So steep sell-off after the elections in US dollar, retesting August, September lows has rebounded, right? Kind of trading below 50-day moving average, but nonetheless still bearish price pattern. If dollar breaks above 95 level, let's say after the runoff elections in January or close, end of December, in anticipation. I don't think a lot of traders right now think about January. They're thinking about end of the year, window dressing. Most of the institutional traders care about underperformance, right? So they need to get their numbers higher for their clients. So I think that will push market to the upside, but maybe by end of December, maybe first January could be extremely volatile. If market pushes to above 95 level, that would be a risk to the equity market. As long as it's not the case, I think equities are going to continue incrementally to trade higher. Lower VIX, right? We're back to 23, 22 levels, so we're back to August lows, right? We're back to actually, end of January. Even before the COVID-19, we were at 20 level, right? That's the historical average. So very, very close to historical average. Not a lot of uncertainty or fear right now in the market. So that's, good morning, Alex. We'll review win. Good morning, Koshik. Equity REITs, VNQ, right? VNQ is a robo investor. So let's go over several questions. So one is, how do you so we have several models. How do you trade in current market conditions? Well, before I do that, no, let's just stick to the plan. So that's, before I get into your answers about, whether should I buy financial REITs or equity REITs? Should I buy Win Resort, or should I buy, how do I use Weekly Trader? before I can answer those questions, you know, I'm very repetitive, but it's because I mean, I believe it takes 7 times to hear something before you understand and internalize this information, right? So that's one of the reasons. Plus, we have new subscribers, and I want to make sure that they understand at least my approach to trading. So my approach to trading is, if you've ever been in a live trading room, if you're not, because you know your plan doesn't allow this, but we do offer live trading room. So if I was subscribing to Tradespoon for the first time, or when I subscribe, you know, I wish that, you know, when I subscribe to these newsletters, I would get access to live trading room, right? Recordings. Most of the subscriptions out there, they actually require you to pay for that. We don't, right? And the reason is because I believe in free education, I believe in training, and that should be free, right? And before you start using the models, you need to understand, you know, how my approach to trading and my approach to models. So live trading room session recordings, they are free, they're available for everybody. If you're a free subscriber, I encourage you to, at least before you invest real money, to watch a couple of these recordings, right? Every day we have a live trading room, every day it gets recorded, and every day you can view it. So in that live trading room, before market opens, I always go over 4 parts of, you know, different routines, pre-market routines. One is the trading plan, one is the strategy, one is the trading journal, and the third one is future rehearsal exercises. So in terms of trading plan, the #1 rule before I make a decision whether I should buy Win Resort or whether I should buy financial REITs, I look at what is my cash level, right? On average, if you look at all of the investors in the United States, retail investors in the United States, depending on your, you know, risk tolerance level, right? Depending on where you are in your journey as a trader, your portfolio size, your age, you know, where you are in retirement. On average, it's anywhere between 20 to 30%, right? Let's call it 25% portfolio cash. So if you're very aggressive and you have high tolerance, you know, you have high tolerance to risk, high resilience to uncertainty, then your cash is lower, right? Then 10, 20%. If you have low resiliency to uncertainty or low tolerance for risk, you have maybe 40% cash. You know, I think having 80% in cash at this point is probably not the right strategy. Having 0 cash at this point, I don't think is the right strategy at this point or any other points. So cash to me is the #1 answer to any of the questions whether I should invest into something or how I should use Weekly Trader. So that's the first check mark. Once you have cash, you know, again, I move cash. Cash is not always the same. I think right now market broke through overhead resistance. You know, I am, you know, maybe a little bit less cash, right? Maybe I'm at 20% cash. As market is going to approach 365, 370, 375, my cash probably going to go to 35%, right? So I'm going to, as market is overbought, I raise cash. As market is oversold, I deploy cash. That's my approach. So cash is kind of moving target. Second one is portfolio drawdown. Position size, I would say, after cash is the most important, right? At any given point, I want to know what is my maximum loss per trade. So if I put on a weekly trader, or if I'm putting on, you know, a monthly trader or active trader, I'm looking at the worst case scenario, right? So if I'm investing, let's say one of the trades from this week in terms of monthly trade, weekly trader, right? Question was on a weekly trader. Let's go. What did we just close? KLAC, right? So KLAC was a weekly trader, right? It was active trader, weekly trader. On both of them, there were a lot of semiconductors. So on Monday, during live session, I sold 232 put for $2, right? So if you look at KLAC, so my approach on November 9th, right? Right, so I sold KLAC on November 9th, right? Which is it Monday or Tuesday, right? When the market opens. Market was overbought, right? KLAC was overbought on November 9th. So I did not buy stock. Sometimes I buy stock, sometimes I sell put spread. So both approaches, that's what I'm utilizing. So I sold 232.5 put for $2. So my break-even point was 230, right? My break-even was 230. Next, I'm deciding, what is my maximum exposure for any given trade, whether it's weekly trade or monthly trader. My goal is maximum loss is 2.5%. So if I sell 230 put, I look as what is the worst case scenario for the week, right? I do see a lot of support, going back to September, right? Multi-month support around 220, right? This is the neckline, double, triple top. So the worst case scenario, if it reaches 220, and it got close, 223. So if I'm at 220 and I sold 230, my cost basis is 230, and I sell one contract, then 100 shares times 10, that's a $1,000 loss, right? So $1,000 loss, and then I look at, do I have 2.5%? Is this 2.5% of my portfolio? If it's less than 2.5% of my portfolio, then I will do this trade. If it's more than 2.5% of my portfolio, then I would lower my stop losses, right? Usually I do 2% stop loss. So if it's a weekly trader, on weekly trader, it's 2% stop loss. So that's about $5, right? So 225, I would exit this position, right? So 2% stop loss on weekly trader. On active trader, it's about 1%. So if I'm holding position for less than a day, it's 1% stop loss. If I hold a position for less than a week, then it's 2% stop loss. So in this case, I would exit out of this position. I did not, because it still was less than 2.5%. I did not have any semiconductors, so I decided to hold on to the KLAC. If I did not, if I had multiple positions in semiconductors, then I would have got out of the trade, because again, my goal, no matter what, not to lose more than 2.5% portfolio. So buying a stock or selling a put spread, that's how I use weekly trader, right? And when model ran, it gives you every day, it gives you support and resistance. Ideally, when you want to enter KLAC on weekly trader, see, what was the weekly trader on November 9th? Google, IWF, Morgan Stanley. So let's do Google, right? November 9th. So on November 9th, Google, 1762, right? The suggested entry price was 1759, right? So ideally, you want to enter at 1759. Sometimes I do use dollar cost average, so you would enter half of your position. Instead of losing 2.5%, you're only risking 1.25. So at 1759, you would enter the first half of the position. At 750, you would enter the second half of the position, right? And then at 1724, you would get out of the trade. So January 9, if you sold the put or bought the stock, you would buy the stock at 1759 level, right? So you would wait. So on November 9th, by the closing, you would have entered at 1759. You would enter the second half of the order at 1750. 1750. And then your stop loss would be 1724, right? So we touched the 1724, you would have exited out that position, right? That's the case scenario. We do give, some range plus minus $12, but that's how you would enter this trade. Obviously, when the market is volatile, we are doing here 2% stop loss, right? 2% of stop loss is, that's the 1724, kind of touch that right here. That's how you would use weekly trader. When volatility picks up, VIX jump, you might, instead of 2%, maybe you make 2.5%, right? Or if you want to hold Google because, that's your position, you would hold it long. But that's how you would trade at this specific setup, right? So that's an example of how you would trade these weekly trader signals. So the most important answer is the portfolio drawdown. As long as you don't have, and this is kind of my point for me, as long as I know, like an example, Google was a perfect example where you would have entered this price, it actually reached on November 10th, 1717. you exit out, you missed it by literally 7 points, 0.3%, very small, only to see that the stock actually reverted back to 1760, right? And right now it's at 1750. So by having this rule of 2.5% maximum loss, as long as you don't reach that 2.5% loss, then you have more resiliency toward when the market reaches these support levels, right? Because usually what I do is I look at the trend line, right? As long as the spiders did not break through this level and just touch, I don't think it makes sense to exit these positions, right? If I saw a breakdown after November 9th of the trend line, 348, 347, this is where I would exit, because this is a breakout of the trend line. It doesn't make sense to hold the long position. It will continue to go lower. But as long as the trend line holds, then I'm in a trade. So having this rule of position size, or doing dollar cost average, where you, instead of maximum loss of 2.5%, you do 1.25%. I think that's one of the most important rules in my trading plan. So maximum loss is 2.5%, and then I look at the number of positions. It's the same thing. If I have too many positions, the market reaches support level, I get nervous, right? If I overly exposed to the market. But if I have a lot of cash, then I'm less nervous, and I'm able to buy at this level. So portfolio drawdown, 2.5% per position. I personally have an average 10 positions because I'm trading active trader, monthly trader, weekly trader, and earning strategies. So those are the 4 strategies that I trade. So 25% I think is aggressive. So if some of you guys have been on these webinars for 4 or 5 years. Some of you guys only been here for 1 or 2 days, or this is your first event. So if you're new to Tradespoon, or if you're new to trading, you haven't traded through February, through the COVID-19, you haven't traded through the Brexit, or through the end of 2018 when interest rates were rising. If you haven't lived through markets that sold off below 200-day moving average, I would encourage you to only have 4 or 5 positions, right? No more than 4 or 5 positions, no more than 2.5% loss per position. So at any given point, let's say you end up on the wrong side of the market. Let's say in January, hypothetically, Georgia seats turn blue, and Senate, Republicans lose majority. More likely than not, that will cause a steep correction, right? Maybe to 50-day moving average, maybe back to 200-day moving average, right? Something that we've experienced in February and January. So that if that does happen, you have 4 or 5 bullish positions, your maximum loss is 12%, right? And I think this is going to be a temporary, even if it's a Democratic Senate, by end of the first quarter, or maybe by end of the second quarter, your market will recover, right? And then you can deploy your cash and continue to trade. If your losses are 25%, 50%, very hard to recover from these losses. So this is the most important topic. Yellow Tunnel is a sister company of Tradespoon, and we have Dr. Maneker, who's a clinical psychologist, who joins us and contributes to the blog. I encourage you to read the blog. And so trading discipline and trading concept of blog and webinar. And end of October, we recorded an event with Dr. Maneker about ending the boom and bust cycle and sustaining high performance. Boom and bust cycle of your own inner market, of your own performance, right? There's outer market, the elections, but then there's inner market, your biases. How do you react to these elections? Are you a Democrat? Are you a Republican? Are you don't care? So all of this will influence your trading decision. So if you're new to trading and you haven't experienced large, boom and bust, or you only experience boom, then I encourage you to be proactive and at least view this recording. Because I believe any trader goes through these cycles. I don't think there's anybody, and I have friends and I have colleagues and I have nephews, and they're like, I started with $3,000, I'm at $20,000 or $50,000. and it's all great, right? They're, they started trading in April and May, and it's continued. Then all of a sudden they get to September, market is down 15%, or QQQ is down 20%. And they started with 3,000, now they have 50,000 in 303, and then market sells off 15-20%, and they lost most of their proceeds, right? So you wanna always decide before the 20% correction, what is your maximum risk tolerance level? What is your resiliency to these steep corrections, right? Especially if you're in technology. So I think this is the most important topic. Maybe at some point, as you go through your journey as a trader, maybe you realize that it's unsustainable to have 100-200% returns in 1 or 2 months, and you'd rather have less volatility in your portfolio, right? That's the usual story that I hear from my friends and from the subscribers. So in order to do that, the only way that I found how to control is cash, portfolio drawdown, right? How many positions you have and the position size. The third one is probability of success versus return on capital, right? I'm using actually 3 different models and an earning strategy. So we have active trader that I trade during live trading room, weekly trader, and monthly trader, right? We've seen example of KLAC that I did. What else did we do? We did, I think, UNH this week, right? So the UNH where I sold the put, for 70 cents, closed it for 25 cents. So selling out of the money puts or buying stock, right? I think, what is it, DHR did I buy? Right, or no, DHR. So DHR or buying stock, right? So you get entry level. So I bought DHR 243, sold it at 245, right? Was able to capture close to 1% profit. So that's those 3 models. The difference between 3 models, that's a common question, is active trader is optimized for 1 or 2 days, weekly trader 1 or 2 weeks, monthly trader for 1 or 2 months. For those of you who are new, who never asked this question, let me know how, if you're new to Tradespoon, what is your holding time? How long do you hold the position? Is it 1 or 2 days? Is it 1 or 2 weeks? Is it 1 or 2 months? Is it 1 or 2 quarters? Or is it 1 or 2 years? So let me know what type, what's your holding time. Alex, QQQ closed up. Every great trade. Thank you, Alex. Joe, what do I mean by cash 30%? It means if you have a portfolio of $10,000, 3,000 should be in your cash. 30% cash means cash. You can say bonds, right? I mean, I would be careful with bonds because they're dropping in price, but cash, I mean cash, 30% cash, right, of your portfolio. When I sell put spread, I usually mean out of the money put spread. So if that sell out of the money put spread, and the strike that I determine is I'm looking for 0.5% for, depends on how long I'm planning to hold the position. So if I'm holding position for 1 or 2 days, right? So KLAC, an example, I wanted to receive 0.5% of underlying stock. So if the stock is $232, 0.5% would be $1.60. So I sold it for $2, right? So around that price. So because I'm looking to capture in this example $1.50, 0.5% or close to 1% gain, right? And in here, I had to hold the position for 4 days actually. Weekly power trader in yellow tunnel, yeah. So yellow tunnel, same thing. If you go to weekly power trader, I think KLAC was active trader, but there was NVIDIA and there was AMAT, right? So those are the weekly trader that were published on Sunday, right? The list gets published on Sunday, similar to weekly trader. The only difference, there's more choices, right? A lot of people ask, what's the difference between weekly trader and weekly power trader? They're similar models. we are using similar models. The goal of both models is to determine the likelihood that the stock will outperform the market, will outperform the sector in the next 5 to 10 days. The difference is that there are a lot more choices, right? The reason, and I think it's, my opinion, the reason I made it this way is that weekly trader, only 3 choices. Because a lot of people, if you're new to trading or you're new to Tradespoon, you know, the common feedback is, you know, Vlad, I don't want to decide between NVIDIA and AMAT. You tell me which one to trade and I'll trade it. But a lot more experienced traders or traders that do a lot more homework or have more time to do research, they want to know clusters, like what are sectors that lead in the market. So you can see AMAT, Autodesk, NVIDIA. So you know technology, semiconductors, Google leading the market, right, last week. So it makes sense to invest. Also banks, Morgan Stanley, Discover Financial, credit cards are leading the market, industrials, Deere, and healthcare, DHR. So you have more choices. You know, if you're already exposed to technology and semiconductors, it doesn't make sense for you to invest in any of these names because you're already in those names. But if you don't have any industrials and you want to invest into Deere, then it makes sense to invest in Deere. And again, same idea, every day you get entry point, suggested entry point for the stocks. Yeah, so weekly, aggressive power trader is the same idea. The list gets published on Sunday, right? The list gets published on Sunday. On Monday, you know, whether it's AMAT or Deere, the idea is that I'm selling out of the money bullish put spread, or I'm buying a stock. I understand some people are not comfortable selling put spread, so then I would buy a stock, right? So I think DFS, I traded actually DFS. DFS came from this list. So when, so in this example, I bought a stock, right? On November 12th, I have the list. I wait usually first 15 minutes. So at 8:42, this is Central Time. I bought it at 72.82. I'm looking for 0.5% profit. So I closed it at $73.30. All right, so captured 50 cents, about 75 basis points. So that trade idea came from this list, DFS. So I have this list during live trading room. I have both aggressive trader, I have weekly trader, and then again, I use my own opinion, you know, if opinion or what my portfolio. If I already have semiconductors, I'm not going to buy, you know, KLAC, AMAT, and you know, NVIDIA. I think that's incorrect approach. You're over concentrating in one sector, right? But let's say I don't have healthcare. That's why I'm more comfortable buying DHR. I didn't have any of the credit card processing in my portfolio, so I was more comfortable trading, you know, Discover Financial. Thank you. Trader, if you can just put your first name so at least I know who you are by name. Alex. Pushing down today. All right, QQQ, right. QQQ is, let me see, they're down. Yeah, so QQQ is, again, under pressure, kind of stalling, trading between 50-day moving average, upper Bollinger Band, that's triple top. Spiders are trading in the box, right? This box pattern, and if I had to pick a date, probably Thanksgiving, right? Going into Thanksgiving, either right after or right at the Thanksgiving, that's the breakout. But next couple of weeks, I think we're gonna trade in this box. 360, right? 360 and 350. So 360 is 350 where the market is gonna trade. All right. All right. Joe Low, J-O, sorry, J Low. First time with Tradespoon, can you cover the options part of Tradespoon? What is entry point? What is exit point? If entry point, right, this is a very common question. What if entry point and exit point is not entered, right? And you are with Tradespoon, right? So let's say today, let's look at active trader. So today, active trader, let's pick the first up, AbbVie, right? So the idea was AbbVie, 97.60 is the entry point. Where does this come from? It comes, why 97.60, or it comes from the predictions, right? You have stock forecast toolbox. This is the model that predicts the high and low for the stock. So at the basically the support is 97.60, right? So the open price is 97.41. You basically say buy at 97.60. That's based on the model prediction, right? The neural network that trained. So you would pick 97.60, right? Let's look, see what happened. Alex actually traded that trade. Right, so the market opens, right? When is it open today, right? It was as low as 97.41, right? So you open 97.41. I usually wait. In this example, you know, it did hit 97.40, but let's say it gapped up, right? Or you waited 15 minutes. Usually in the live trading room, I wait 15 minutes, and the stock is at 97.86, right? So it never, you know, it's above 97.60. So 97.60, 97.85, it's 20 cents, right? 20 cents. It's within this standard deviation of error. I do know that pre-market futures were already up. Most likely healthcare is going to continue going higher. I would enter the trade, right? So if it's a small gap, you know, 10 cents, 20, you know, 10 basis points. I'm not trying to capture 0.5%. So if it's 10, 20 basis points, I would enter the trade. Let's say it gapped up to 98.50 before it opened. Usually I do not chase the stock. So it depends on your style. I think you need to be consistent. I know there are some traders that they don't care where the gap is. They buy in at the open, right? They buy in at the open, especially by looking at the pre-market futures, right? Pre-market futures will dictate whether you want to get into this trade or not, because market already rallied in the pre-market session, right? We were as low as 351, right? We hit the support at 351 in overnight futures, and by the time market opens, we were already at, you know, at 355. So you know it's going to be most likely a bullish day. So you want to, then you would enter FD, right? And you know, obviously, you know, today very strong move, you know, almost 2% move to the upside. So if there is a gap, it all depends. Let's look at CL 8270, 8473. Let's see, the CL hit 8473. 8473. Well, actually, well, probably not, right? So CL is a perfect example. It opened, I mean, the low is 84.69. Most likely you didn't get it. So it's at 84.79, right? The first opportunity is 84.79. So to answer your question, usually if it's a gap of 1%, 2%, I don't chase the stock. I actually wait for a pullback. Once CL reverses back to the opening price, 84.74, then I would consider entering this trade. So if it's a large gap, I don't chase. If it's a, you know, if it reverts back to the open price and based on the market conditions, then I would trade, right? Strategy A, you always look at the pre-market futures on Tradespoon, right? If you see futures are down, you wait for strategy A, predicted low. On a day like when the market is up 0.5%, most likely predicted low will not be entered. So I'm concentrating on strategy B. If today the futures were down 0.5%, then I would concentrate on strategy A. And weekly the same way. So this is the active trader, right? Holding time is usually 1 or 2 days. Weekly trader, holding time is 1 or 2 weeks, right? So for, let's say, for example, of Google, you know, when I would enter on September 9, when I would enter, I would go in like I did with KLAC. I would either buy a stock, you know, if you're a stock trader, I would buy it at 17.59. So when it reached 17.59, I would enter the stock, right? Both strategies show 17.59, and I would put, you know, weekly trade is usually 2% stop loss. So 179, it's about $80, right? So 2% of 1794, 1% of 17, 17, 18, 36. Right, 2.5%. So it's about $70. Right, so at 1724, if you're doing a stock trade, then it actually did reach 1721. So at that point, you know, you exit the position. All right, that's a 2% stop loss. I personally did not exit because I was looking at the spiders. So I gave, you would downsize the trade, and then I look at the support and resistance level, right? It did reach this 250 on November 10th. If it broke down, maybe another 1%, then I would exit the trade. But that's how, this is how you would use these entry and exit prices. Yellow tunnel. So the question was, explain the difference between yellow tunnel and Tradespoon. Tradespoon, I started in 2012, right? So it's been almost 9 years. And back then, my philosophy was, I have a master's degree in computer science. I was CTO of several broker dealers. I was part of several hedge funds. So I said, I was concentrating on models and education. So you have a free education, you have several models, and you have different blog, right? Learning center that you can read. We have free workshops. We have free learning center where you can look at the trading guides, for different tools, different strategies. You have training if you want to learn about technical analysis, option basins. So that's Tradespoon. Then, a few years into it, I'm realizing that it doesn't matter how good your models are. It doesn't really matter how much you know about options or stocks. When the market sells off 20%, right, in February, when it sold off, let's go back to these 1 weeks, right? 2018 September, right? 2018 November. During these periods, when the market sells off 20%, drops below 200-day moving average, I actually know that every time market drops below 200-day moving average, we have a lot of support tickets, right? We have a lot of supported tickets. People are saying a lot of models don't work, right? And why? So I'm realizing that. And that's the reality, not just with Tradespoon models, any models, that these sharp corrections that happen in August, that they happen in February, no model can detect them, right? That's one thing that, you might not agree with me, but you might anticipate correction, right? I anticipate rally, I anticipate correction, but you cannot time it. You cannot say on this date, it's going to drop 10%. On this date, it's going to run 20%. Nobody can do that, right? You can say market is overbought and potentially can drop 10, 20%, but it can happen tomorrow, or it can happen in March, or it can happen in July, right? You don't know that. So by definition, then models, when VIX, right? You look at the VIX, right? VIX jumps to 80 or 40 very rarely at random times. So model cannot train, right? Any models cannot learn on this data because there's just not enough data points in the past 100 years that can find these outlier events. And we actually tried. We have very strong, financial engineers that have, PhD in physics, mathematics, that, actually, had a lot of awards, in the United States and in Russia. We tried to build the model that find random, find probability of these random events, and we could never do that. So I'm a believer that you cannot time these corrections, nor can you learn what happens exactly during these corrections. So by that definition, I realized then what do you do? So that's the idea behind the yellow tunnel. The yellow tunnel, I'm, in the past few years, I'm a strong believer that psychology is, I would argue, more important than the models and more important than your ability to read technical analysis. Because if you're overexposed to equities, you're 100% in equities and the market sells off below 200-day moving average, or 20, 30%, you will, my opinion, that you will have a lot of losses, right? Losses that you don't expect. So to deal with that, the idea is trading psychology. So I invited Dr. Maneker. He was kind enough to join Yellow Tunnel. He's a professional trader, right? He trades full time. This is his main source of living, is trading. but he also does one-on-one coaching and trading psychology. So he's very unique. You will not find a lot of people with that background and resume. So I'm very excited. And so create Yellow Tunnel, it's not about, we don't have any content of how to trade options or any content on technical analysis. The content is, I do believe in models, because I do believe that most of the time, right? Most of the time, VIX is trading in this, in the range, right? When VIX trades for years in this range between, call it 10 and 20, models do work really well predicting support and resistance and trend. Models just don't work when VIX goes to 80 or in one day, or in 1 week, or in 1 week it jumps from 20 to 40, right? I don't care which models you have or which technical analysis you have, you're not going to detect these events, or you're not going to be prepared for these events. I believe the best strategy for jumps in volatility is trading psychology, right? Because anybody can, not anybody, but a lot of people can make money when VIX is in trend, right? It's in the box, right? It's trading between 23 and 12 for 2 years, or for 5 years, right? I mean, you have these jumps, but for the most part, for weeks you have. So the model works really well when VIX for weeks or months trades in this box, and then it stops working when the VIX jumps from 20 to 12 to 24, 12 to 31. So trading psychology is more important. So Yellow Tunnel, every week we have a blog that Dr. Maneker, so I publish the blog on the market conditions, but then every month or so, Dr. Maneker helps out with the blog. We also have webinars that I encourage you to review, ending and boom and bust cycle. I think it's extremely important webinar, understanding your inner market. Your inner market, your views on politics will influence your trading decisions. And as you're going into elections, I believe, runoff elections or these elections, I believe that depending on your political point of view, you will rebalance your portfolio different, right? Because you're hoping that your party will win, or and you're not taking into consideration what if your party loses, right? So I think managing extreme uncertainty, I think all of these are very important events. So that's the reason for trading psychology. This content is free, right? So I encourage you to read the discipline, the webinar, and the blogs. And the only reason you would do this is that because I don't know when VIX is going to jump back to 40, but I know it will, right? I know it will. More likely than not, it will happen this year. It's just hard for me to determine, will it be in January, or will it be, in May or July, but it will be at 40, and you want to be prepared when VIX is at 40 or at 50. And if you think you can find a model that will let you know, a couple of days before that happens, most likely you will not, right? So the idea is, how do you prepare for that event? Because once that event happens, it's too late. When VIX jumps to 50 and you're bullish and you're 90% in equity and all of your positions are in high growth tech stocks, that's when your portfolio drops by more than 25%. So you want to avoid, one of the main drivers behind your trading decisions are fear of future regret. My fear is that market is at 40. I don't have any cash. I can't deploy my cash. I don't have cash to repair my position. So the fear of that precludes me from over trading, because as soon as I trade, I always think about, what's going to happen if VIX is at 40. Right, so that's the important part. Great question, thank you. No, Joe, 30% cash means 30% is not at risk. So 30%, 70% is in, if you're 30% in cash, 70% in equities, long equities, then you're exposed 70%, right? And then you look at, potentially 20% drop, you might lose, 20 out of 70, 15%, right? So your market portfolio drawdown, assuming beta 1, you're gonna have 15% drawdown. Leonard PHM is up, thank you, and other options. And the options I am trading either the same week, sometimes next week, right? So the question was on weekly options. So let's say KLAC. I personally trade the same expiration date, right, November 13th. When I enter them on November 9th, some people do 1 week. So I don't think there's right or wrong. Is weekly trader better for new people if you're signing up to Yellowtown? I don't think it's better. I think it just depends. Weekly power trader on Tradespoon gives you 3 choices, right? So you have bank, you have small cap stocks, and you have technology. Those are the leaders, and you only have 3 choices. If you go to aggressive power trader, you have, you know, 5 not power weekly power trader. If you go to weekly power trader, you have 3, 6, 8. We have subscribers that subscribe to both, right? Because they want more choices. So if you want more choices, more than 3, then I think yellow power is better. If you want less choices, then, you know, weekly power trader is for you. And I mean, if you like, you know, you might want to have both, you know. So that's my answer to that question. So Joseph, so elite subscription, right? The question was, if you're elite subscriber, if you're a premium subscriber, what do you gain for elite subscription? So there's number 1 question. You guys want to guess what's the number of questions during the webinars that I get asked? Joe Lowe, sorry. Joe Lowe, sorry about that. Sorry, I don't have recordings on how to use Ameritrade, or, you know, but you will have to contact Ameritrade. I do have recordings of how to use it with, sorry, I'm jumping. So, sorry, so let me answer Joseph's question. So first is, if I'm a premium subscriber, what do I gain from elite subscription? What you gain from, so the most common question, if you answer this, Vlad, you know, what is your view on VIN or financial read, and when do I exit this position, right? So if you want to know when I enter these trades or exit, right? Because weekly trader, you know, I didn't trade Google, I didn't trade the IWF, I did trade Morgan Stanley, right? So if you want to know when did I trade Morgan Stanley? Am I still in Morgan Stanley? Do I exit Morgan Stanley? That's elite subscription. Elite subscription, if you're an elite subscriber, you can view my position, my orders on Morgan Stanley, right? You can see that Morgan Stanley, you know, I bought 50-55 call spread, right? I bought 50-55 call spread on October 26th at $2.30. I closed it at $3.30, and I have an order to close it at $4. So if you want to know when I trade Morgan Stanley, if I trade, and when I exit, then that's the main advantage of elite subscription. You have this access to trader log. You can enter your phone in an SMS, and then it's synchronized real time with my account. So today, KLAC, if you want to know if I'm still in KLAC or not, you know, as soon as I got filled, when the market opened, you get SMS message that says, you know, there is activity in KLAC, and you can look at the trader log and you can see, okay, Vlad sold 232 put at 9 a.m. on 11:09 and 11:13, he closed it for 50 cents, right? So that's the advantage of the elite subscription. We also have closing bell. So in addition, we have closing bell every day, the last hour of the day, you will see me trading live, and you also have weekly subscription as part of this membership. So elite subscription gives you everything that Tradespoon has to offer. And if you want to know when I trade or which of these signals I trade personally, which a lot of people do, then elite subscription is something that you can select. So Deborah, in terms of how to use broker dealers, I don't have all of them, obviously. You know, there's just too many broker dealers, but I do have video training, option based trade management. So actually we do have trade management, how to place stock trade, how to place option trade, how to place option spreads with the trading block. So I'm an investor in trading block. You know, this is the important to realize that. So I'm an investor in this broker dealer. So you can find the disclosures here. But the main point is that most broker dealers are very similar. The way you place option or stock trade on trading block is the same on TD Ameritrade and Fidelity. Not much of a difference. Jolo, thank you. Trader, sorry, yeah, I'm not sure what your name is, but thank you. Joseph, thank you. Okay, so let's see other option. Did I answer all the questions? Okay, so Jolo, so the VIX, this is not Tradespoon technology, so TradingView. TradingView, you can get free access to these graphs, right? Just open up account with TradingView. We don't have marketing relationship, there's no affiliation. These guys are, I mean, this is one of the better charting tools out there. And it's free. You're not gonna get real-time quotes. If you have real-time quotes, you have to pay, but you can get delay quotes and get it. All right. There was a couple more questions I forgot to answer. VNQ, so we do have robo-investor. So in addition, so some of the portfolios that you can follow is Elite, already described Elite. Subscription, this is where I trade real-time, active trader, monthly, weekly trader. We have some premium subscribers. You have 4 trade ideas a month, right? DHR was the premium subscription. You get a video explaining, and same thing, you get email and SMS every time I trade, right? So I'm trying to get into 240 to 30 call. I think I actually got filled. Let me update this. Right, so that's DHR, right? So I personally trade option spreads, right? So I bought 240 to 30 calls, sold 240 for $5. So if you want to learn how to trade options, there's an instructional video. There's an instructional video that you can see for DHR, right? I encourage you to review it, and then you have choices. If you're not comfortable trading spreads, you can buy stock, right, or an option. So that's premium portfolio. You get SMS message, you get emails, you get video with explanation. If you're not comfortable trading stocks options, then we do have robo investor portfolio. So the question was on VNQ. This is one of the positions, and all of these positions are stocks, right? So I have about 20 to 25 positions at any given time. I do use dollar cost average. Sometimes I would close half of the position. Sometimes I would buy half of the position. My target gain is 10%. Stop loss 10%. And again, you see all of the SMS message. You can look at the portfolio performance, and you get email and SMS message every time I trade. So premium, I personally trade spreads. Robo investor, I personally trade stocks. The question was financial reads. Again, my approach top to bottom. I think all the there, some like CCI was, there's some real estate investment funds better than the others. If you don't want to do the stock picking, then VNQ, right? We attempted to break to the June 8 high, false breakout, pull back. My view on financial reads, they're going to continue to go on higher, right? This is a part of this value reflationary trade. At some point, vaccine is going to be available. At some point, a lot of people will get vaccinated, and we'll have that herd immunity. It might not happen today. It might not happen Q1, but end of 2021, end of 2022, it will be, controlled better than it is now, and market already sees that, right? Market already trades as if coronavirus is contained. So market is forward looking, and if you think that by end of next year financial rates will be at 100, and there's 15% to the upside, and it pays you 4% dividend yield, much better than 20-year bond, people are going to start buying it. I mean, it's not going to be a one-way street, right? If you're buying at 84, you probably want to also buy at 75 and be happy when it reaches 75. Don't assume it's a one-way trade, but you buy on any pullbacks. That's the strategy, and you use dollar cost average. And between the yield and additional 10% upside, I think people are going to move into financial REITs. All right. What are some of the other questions? So that's VNQ. Sorry, Wynn Resort. I mean, again, my approach is top to bottom, right? Hilton is, almost at 52-week high. That's incredible. I guess people using Hilton. Marriott using, no, not Marriott. Not a 52-week high, close, right? And Wynn Resort, obviously it's not just a hotel, but also casino and gaming. It's the same price pattern, right, as financial REITs, right? No difference. June 9th, that second week of June was a lot of overhead resistance for value stocks, energy, banks, all COVID-19 stocks. My answer to all of them is the same way. Do realize that Wynn Resort is highly correlated to Boeing, even though they don't have anything to do with it. And JP Morgan, right? Different industry, different sectors. One is a little bit better than the other, but same price pattern, same chart, right? High correlation to each other. So keep that in mind, and don't have 90% of your portfolio. I think allocating 90% of your portfolio to these value stocks that got affected by COVID-19 is also not the most efficient strategy. Realize that Wynn Resort and Marriott and Boeing and JP Morgan, they will trade on the coronavirus news, right? Good news, they're all going to move up, and bad news, they're all going to move down. So you want to be diversified, right? You want to be diversified between growth stocks, maybe small cap stocks, maybe some industrials, but you want to be diversified. Kevin, thank you for your feedback. Okay, I get it. We actually working on the wealth management option. We're going to partner, but we're probably 6 months to a year away. But we will partner with wealth management. Right now, I don't want to manage others people's money, but at some point we'll just partner with another wealth management company that will use Tradespoon technology. But that's on the horizon. Apple is not participating today. So again, it's not just Apple, Microsoft technology, rotation from value to stocks. QQQ is flat and value is outperforming, right? I think that's going to be the theme, but I would buy on pullbacks, right? And QQQ at 50-day moving average, I would be a buyer. QQQ, at 200-day moving average, I would be a buyer. I think, market cannot continue going higher without Apple or Microsoft, but you will see kind of the theme in the past 3 months, money are floating between growth and value, right? One day VTV is up, one day QQQ is up, right? And very rarely both of them are up. But some days they're both up, but most of the time it's kind of rotation. People are still trying to figure out where the better investment. I think the consensus is QQQ, I don't know, maybe will break out, maybe 5% upside, but value, there's a lot more upside, right? I think value will break through this 52-week high. So that's at least another 8 to 10% up. Where QQQ from this point, another 30 points, 320 are less likely, right? Or at least VTV will be up 10% before QQQ will be up 10%. Okay, Kevin, we're not going to get into politics, but I appreciate your opinion. Apple seems to be both growth. I don't think Apple is both growth and value, right? I mean, it does pay a nice dividend, but it's acting more as a growth stock, right? The chart pattern of Apple and the chart pattern of Teladoc, pretty similar, right? I mean, more exaggerated, but you can see this overhead resistance and can trade through it. But this is considered to be growth. It trades like QQQ, right? And technology is considered to be a growth sector. What do I see with Deere? I don't know. Did you buy stock or option? Oh, you bought options. November 20 call. November 20 call. I still think there'll be a rally by November 20. Industrials. Industrials are up. The problem with long calls that the time is against you, right? So you bought November 20 call. I don't see the strike, but I assume it's out of the money. So the problem is buying out of the money call, and I think by November 20th is just going to trade in a box. That means the time frame will deteriorate against you, and unless Deere breaks through 260, most likely this trade will be a losing trade. So consider maybe closing the long call, out of the money long call, and selling a put spread, right? 240. You clearly see 245 is a strong support, so maybe sell 245 and 235 put spread, or 245 240 put spread, right? That has high likelihood that because the time decay will be on your side if you sell and put spread. If you cannot sell put spread, or you're not comfortable selling put spread, then maybe I would close the long call and just take the loss, or at least buy deep in the money call, because there are a chance that going into November 20th there might be a rise in the call. But the problem is if it's out of the money call, it's a race against time, right? Because you have a very high theta, and the call premium will decay rather quickly in the next week. But if you have a deep in the money call spread, the time decay is going to be impacted significantly less. Marvin, what do you think about MasterCard and Visa? It's best to buy calls or put in options. The problem with calls in general, the reason why I only trade calls, if you trade calls for short period of time, or if you anticipate a large move, then it's great, right? Unusual options activity, earnings, if you think. But buying calls on MasterCard, I think the market is going to trade in the box. That means every day you have high theta, and the premium, there will be decaying premium. So my preference, synthetic stock. So I would sell a put long term. I would sell a put maybe March MasterCard, and then I would buy a call and sell a call, debit spread. So if you want to do MasterCard, I think the best strategy is debit spread or synthetic stock, right? But because the VIX, the idea is that VIX is going to decay, right? VIX went from 40 to 23, but it's going to continue to go down, right? I mean, it can jump to 40 in January, but long term, it's losing its value, right? That means your long options losing its value. So synthetic stock, debit spreads, something that you're not subject to time decay, right? So, and long calls and long puts, they're subject to time decay. So I think the easiest to understand, then you do debit spread. Bob, thank you. 247 strike $7. 247 strike at $7, your break even is 254, which is kind of this box, so you have $5 in premium every day, you're going to lose value. So I personally, and I don't know if it's going to jump or not. So, it's hard for me to tell, but, I know that time is trading against you unless Deer jumps to 255. I mean, there's over the weekend, I have no idea what the news are. They could be positive, they could be negative. But I know every day that your call, 247 call, will decay in value. So consider, either sell put spread or at least buy deep in the money call, because 247, it's not deep in the money call. It's like at the money call. And today's Deer, value stocks are actually up. Value up is 1.5 and Deer is underperforming. So industrials are underperforming today. Let me see, which is not a good sign. Oh no, XLI is up. So XLI is trading with VTV, Deer is underperforming. Deer, Caterpillar, they're underperforming because they're, they made such a significant move up that I think selling put spread is a better strategy. Kevin just wants to get me into politics. If we're going to start talking about politics, we're going to stay here till midnight. And I appreciate your opinion, Kevin, and that sounds great. General Motors until the end of the year. Yeah, General Motors, the value stock. So it is overbought. I would not chase it, but if you're already in General Motors, I would wait till the end of the year, because I think there's a strong support at 38. If it drops to 38, I would add. 36, I would add, but it's the same trade. All right, guys, 10:44. Sorry, it took a little bit longer. A lot of questions, a lot of people today. Thank you. I appreciate your support, and spend some time with your family and friends. Recharge. I'll see you on Monday, and don't forget to watch. If you haven't watched, how many people did not watch Trading Ending and Boom Cycle of High Performance? How many of you did not see it? All right, so if you did not see it, open Yellow Tunnel, just go into home page, click on, join for free, sign in, right? Open, enter your email and go under quick navigation, trading discipline, right? And just watch this video over the weekend, fast forward. I hope it will help you over a long period of time. All right, you guys have been wonderful. Spend some quality time with friends and family, read a good book, watch a great movie, and I will see you Monday. Alex, Andre, Ann, Arunas, Bob, Bog, David, Deborah, and Faust, Harry, Joe, Koshik, Kevin, Lalit, Leonard, Mario, Marvin, and NIP, Patrick, Phil, Ray, Rebecca, Ricardo, Robert, Sean, lots of traders. Please update your profile and re-register. Venka and Vitus, William, thank you very much, and everybody else, and have a great weekend.